Yes, it's true that Europe is currently not necessarily enjoying an awful lot of good headlines. At the same time, we think in terms of just the growth numbers per se, it's in a weak recovery. So we have seen positive consumption dynamics. They may be a little bit more subdued than the last quarter, but overall, that picture of essentially inflation being lower now than wage gains, that is still with us, and that should help the domestic consumer. But what you just mentioned and alluded to also relates to the exports, and the export markets are not particularly strong for Europe. I think right now, I think we have seen good export that was mainly tourism exports and good out of, say, France and Germany didn't look so great recently. So I think there is something what some observers call a manufacturing recession, which we also see in the PMIs, that doesn't really help that picture.
The manufacturing malaise is something we keep on noting every time we see those PMIs offset, funnily enough, by the periphery and the services that we're seeing around tourism. But when you look at the news flow out of China, do we just get rescued by the Chinese?
So our team before the stimulus was announced, actually had downgraded its expectations. And then, of course, we are cranking the numbers. Most of the impact is typically in Germany, but there was some read across to Europe. It wasn't terribly great because anyway, our assumptions were already that it was relatively subdued, that manufacturing cycle. Now, I think we might get some positive spillover from that, but maybe not as big as is needed. Our team in China clearly says more is needed. I think we had commentary from you saying before, some market observers say this, and I think we are firmly in that camp.
Jens, you are a terrific person to speak to, not only because you're a very important person at Morgan Stanley, but also because you spent 15 years at the ECB. So here's the question. Yes, the ECB is going to cut. Yes, we think it's going to be an accelerated process of cutting. There's no reason not to when you look at the inflation stroke economic dynamic. But could the real bang for the buck be from releasing Germany from its fiscal constraints? And could that act as an important catalyst for Europe rather than the expected rate cuts?
Yeah, no, I think I agree with that in the sense that it's probably something what needs to be looked at in the fiscal domain. Now we see Europe in the next, this year and next for sure, going through a mild consolidation. And of course, Germany is also consolidating. And here, indeed, you could argue a lot needs to be done in terms of investments, in terms of infrastructure spending, and ultimately the constraining part here is the debt rule. And indeed, it's something that already this current coalition had been thinking through, but I think there is no majority right now in parliament. And so a lot of investors are looking for the election next year, 28 September, so basically in a year's time, and then for a new government to tackle that issue. Needless to say, rate cuts will help. And of course, the trajectory of rates in Europe is firmly down.